Welcome to Kitco News and our continuing coverage of the virtual Denver Gold Mining Conference. Here to talk about the health of the senior producers and the impact that COVID-19 has had on production this year is Sean Boyd, CEO of Agnico Eagle. Sean, it's a pleasure to talk with you. Thank you for joining us today.
Yeah, great to be here.
So looking at Agnico Eagle, in the second quarter, you guys reported lower production. I mean, it's expected as everybody sort of was impacted by COVID-19. What's your expectations going forward for the second half of the year as we still deal with this virus?
Sure. I think, as most know, we were hit harder than most, having 7 of our 8 mines impacted, several of them suspended. The operations in Quebec and the operations in Mexico suspended. Also impacted our mines in Nunavut, where we scaled back activities to protect the communities from the virus so that we could isolate those communities. So as we said, more of an impact on us than others. But what we're really focused on is clearly to protect the employees, keep the comfort level of our employees and their families high, contribute where we could to the communities. But at those assets where we're at reduced activities, it was important for us to keep the employees that were still there focused on managing some of the things we needed to address at mines like Meliadine and Amaruq and LaRonde, which we successfully did. At Meliadine and LaRonde, we had the issues addressed before the impact of the virus. At Amaruq, we had some things in terms of catching up on a backlog of maintenance. So that was done early in the second quarter. We actually closed the second quarter strong. We had a very strong June, which sets us up for a very strong second half, which is what we expected to see. So that's happening now in Q3. We're essentially back on track and where we expected to be prior to the virus impacting us in mid-March.
So I was going to say, so your production is at pre-COVID levels then for you guys?
That's correct. We've been forecasting production in Q3 and Q4 to be very similar to what we saw closing out 2019, which was a record quarter in terms of production, in terms of total operating margin coming out of the mines. That's where we expect to be in terms of production, but at much higher gold prices, which will drive a lot of free cash flow here in the second half of 2020.
What are your thoughts on future production? Should investors be preparing for lower production, or do you think we can manage with the pandemic around us?
Yeah, the approach is to manage, and I think we can make a very strong case just based on how we managed in the second quarter and how we continue to manage in terms of the protocols, which essentially protect the employees and give their families a comfort level that the employees should be coming to work. One of the things we did do early on, probably faster than most companies in Canada, we adopted testing. We had a testing facility up and running in early April. We have 2 testing labs running today, one in Val-d'Or and one in Nunavut. Our Finnish employees early on were tested. So our employees, I give credit to the leadership at the sites for sourcing out testing and for implementing that testing protocols. That gave us that extra layer. I think the government's really appreciated that leadership on testing. And what we were able to do in 2 instances, in Quebec and Mexico, the mining industry, including Agnico, were able to demonstrate to the governments that mining should start sooner than general industry was allowed to start up. That happened both in Quebec and Mexico. And really, as we look forward, I think the key for the mining industry is to point to the fact that, the industry lends itself to natural physical distancing. We're used to isolating employees that get sick with the flu in remote camps. We didn't have to entirely reinvent our business. We had to adapt our business, which I think Agnico and the industry has demonstrated. Going forward, though, we have to continue to make the case that mining is essential. In our case, Quebec and Mexico both deemed it non-essential. What we've heard from both of those governments is mining's clearly essential. We're hearing it from the federal government in Canada. Why? Because they know we can operate safely in the midst of a pandemic, but they also realize that the businesses are extremely profitable. and economies have been ravaged. So if you have industry and you have an industry like gold mining that's doing extremely well, which means we'll be paying taxes, those are industries you need to support and you need to deem them essential. So that's the argument we'll make, which means we feel comfortable that we can manage through if there's a second wave.
I think helping to manage production and stuff like that has been higher gold prices. In December, you called for $2,000 gold this year. Congratulations, we hit it last month. What are your expectations going forward? Does gold prices go higher from here?
Yes, they do. And we were publicly bullish in 2019, even saying that in my over 30 plus years in the industry, I was as bullish as I ever was in 2019. And I think what the response to the pandemic in terms of trying to manage the economic fallout has only made a stronger case for gold. And I think we have to kind of step back here a little bit and think about what we were thinking as an industry and in the investment community 5 years ago when gold was 1050 late in 2015. We were looking up at 2000 and we're thinking, boy, are we ever going to get there? You know, maybe to get there, the world has to be coming to an end or the financial system has to be totally devastated. We didn't subscribe to that. So here we are at 2000 on the basis of rising debt levels, rising a lot faster than anyone expected, and economies not keeping up to the growth in debt, which means we would subscribe to what Martin Murnfield says is that there's two ways to go. Austerity, which politicians don't have the courage for, the general public doesn't have the appetite for. So it's going to be spend more, print more, try to create inflation, which is perfect for gold. So if we look from 2000 now and look at 2,500 or look at 3,000, again, as we look up, the world doesn't have to be ending to be at 2,500, to be at 3,000. We can be in a situation similar to today where debt levels continue to rise and investors decide, look, in this environment, low interest rates for longer, we need to have gold exposure. So I think that's a different argument than we would have had over the last 20 or 30 years where, you know, we weren't doing ourselves a disservice, I think, calling for multiple thousands of dollars of gold price because they used to just sort of dismiss us as, well, that's a crazy industry. They're making crazy claims on the gold price. But here we are at 2,000 with it not being unreasonable to assume 2,500 or higher. And 2,000 is going to have a substantial positive impact on earnings, cash flow, and free cash flow. And the industry has not been able yet to flex its muscles in terms of what does it look like at these higher gold prices, because in the second quarter, we had the impacts on production of the virus. Q3 coming up very soon. In a few weeks, just after the Denver Gold Forum, companies are going to be posting earnings, posting cash flow per share, posting free cash flow. That's when investors are going to start to pay attention and conclude, boy, this is how we get leverage. This is an industry that's not just going to have some of its best historical performance in decades. It's going to post probably its best relative performance relative to a lot of other investment opportunities, given the cash flow that comes at $2,000 gold, with the prospect that we could be in a higher gold price environment.
So cash flow increasing, margins extremely healthy. What do you do with that money? Where do you see the value? Is it growing your pipeline? Is it giving back to investors through dividends or share buybacks? Where do you put the money?
Well, that's the nice thing about the supply-demand equation right now. Even at 2,000, the industry is not positioned for a meaningful supply response. They wouldn't be even positioned at 2,500. These projects take a long time to get built. They cost a lot of money to get built. There's way too many mining companies and not enough high quality opportunities. So supply isn't going to be an issue. Companies will move projects forward. That's fine. But really what they need to do, because there's still a lingering doubt out there among investors. Will this be a repeat of 12 years ago? Will the industry fail to deliver the margins that we're expecting them to deliver? We argue the industry will deliver the margins. There's two principal differences today versus 12 years ago. One, we have nowhere near the input price pressure we were facing as an industry. And we were facing that pressure because all resource-based industries were booming, drawing on supplies, drawing on contractors, et cetera. We don't have that. And going forward, we have a reserve base that has been priced conservatively for the last 7, 8, 10 years, and we didn't have that 12 years ago. We had a reserve base that was massively diluted with a rising gold price being used in the price assumptions prior to that run, significant run in the gold price. The third part of that piece is discipline. And so the industry has to not only talk discipline, they've got to act like they're disciplined. And the best way they can act like they're disciplined is to pay meaningful dividends. And we've paid one for 37 years. We've increased it every year for the last 6 years while we're in the middle of our biggest CapEx program in our 60+ year history. It's time for companies to demonstrate the confidence they have in their business, the confidence they have in the gold price, and pay more dividends. That will go a long way to alleviate the fears that some investors have that we're going to see a repeat of what we saw a dozen years or so ago.
Well, and it appears to be working. Just taking a look at your the company's share price, you're actually outperforming a lot of the majors, outperforming gold price. What's behind, do you think, this performance in the price? Is it the fact that you do want to give value back to shareholders, even as you put money into the ground as well?
Well, we look at this over a long-term horizon. And as we've said many times before, the sort of base we use is when most of us got our current roles at Agnico, and that was back in 1998. We had one mine, LaRonde. It was a great deposit, but it was not without its challenges, given it was multi-metal, given it was deep, going to be deep. So it hasn't been easy, but we set out on a strategy which was really per share focused, keep the share count down, look at opportunities early that we thought had really good geological potential, drill them, expand them, and then use our own in-house mine building skills to turn them into meaningful parts of our business. That's worked extremely well. Here we are, the share price is over $100 Canadian, so it's up 20-fold. So we look at on that metric. And so that's dramatically outperformed over that period. The XAU dramatically outperformed the gold price, dramatically outperformed the S&P. So I think investors, what they see when they look at Agnico is consistent approach, consistent management, per share focused, measured risk. I think risk is a big part of it. When the generalist investors show up here now and start to inquire about making investments in the gold space, in the gold mining space, they're risk averse. They spend the first 20 minutes of an hour-long meeting trying to assess risk. So Agnico's been able to keep risk low, whether it's political risk, financial risk, technical risk, execution risk, keep it low, take geological risk based on the view that our experienced exploration team has about the deposit, and make that happen. And that's what we've been able to do consistently, and that's what the strategy doesn't need to change, it's effective. So that's what we're going to do as we move forward.
Sean, I've really enjoyed this optimistic talk. Thank you very much for sharing your thoughts with us today.
It's good to be here, and it's nice to join you when we're a little bit warmer. I remember we chatted last at Meliadine. It was a lot colder and snowier.
And that has come a long way. That's now full production. I mean, aside from the COVID-19 issues, but that's in full production now.
Yeah, Nunavut's a good long-term platform for us. We'll be there for decades, lots of opportunity there, experienced teams. So we look forward to doing a lot more up there.
Perfect. Well, thank you very much for your time.
Thanks, Niels. Great to be here.
Thank you for watching Kitco News. For the latest in the precious metals markets, go to kitco.com. Stay safe, stay healthy.